All right, let's talk about a powerful trend-following strategy that's designed to do just one thing: make your trading simple. If you've ever found yourself just staring at your charts, totally overwhelmed by all the indicators, well, this is for you. We're going to cut right through all that noise with a clear, black and white set of rules designed to kill analysis paralysis.
So let me just kick this off with a question that, sounds kind of crazy. The common wisdom, right, is that you've got to have this super high win rate to be profitable. But what if I told you that with the right strategy, you could be wrong on 5 out of every 10 trades and still make money? See, the secret isn't about winning more often. It's about making sure your wins are bigger than your losses. This chart right here, this is the engine behind the whole strategy. It's all about a positive risk-to-reward ratio. For every 100 bucks you put on the line, the goal is to walk away with 150. That simple 1 to 1.5 ratio is the math that makes this whole thing tick.
So here's our game plan. First, we're going to really unpack the math that lets you win, even when you lose. Then we'll get into our simple toolkit. After that, it's the nitty-gritty, the exact rules for getting into a trade, and just as important, how to get out. And we'll wrap it all up with the mindset that you gotta have to make it all work.
Okay, so let's jump right into the numbers. This part is all about the simple arithmetic that makes a 50% win rate profitable. This is the why behind the how, and honestly, it's the bedrock for everything else we're going to talk about. So, the guy who came up with this strategy, he admits he used to be a total indicator junkie. His charts were so cluttered he could barely even see the price anymore. He had a classic case of analysis paralysis. You know the feeling, right? When you've got so much conflicting information, half your indicators are screaming buy, the other half are screaming sell, and you just freeze up and do nothing. Well, this strategy, it's the antidote to that. And this table right here just lays it all out crystal clear. Let's just pretend we take 10 trades. You win 5, you lose 5. That's a 50-50 shot, right? Well, your 5 winners at 150 bucks each, they bring in $750. Your 5 losers at 100 bucks a pop, they cost you $500. So what's the bottom line? After all that, you're still up $250. This simple math is exactly why the system works.
Okay, so the math checks out. But what tools do we actually need to make this happen? Now that we get the why, let's put together our toolkit. And the best part? You don't need any fancy, expensive software for this.
And here it is. This is the whole shebang. We're going to use something called range bars for our charts. We'll get to that in a sec. And then just 3 classic, no-fluff indicators: Bollinger Bands, the MACD, and the RSI. That's it. We're keeping it simple, remember? First up, Bollinger Bands. Now, for this strategy, you can totally ignore that middle line. We only care about the 2 outer bands. Their job is super simple. We just look at their slope. If the upper band is pointing up, that suggests an uptrend. If the lower band is pointing down, that suggests a downtrend. They also help us nail our entry point. Next up is the MACD. Okay, think of this indicator as your traffic light. It just tells you which way to look. If the MACD is bullish, you've got a green light to start hunting for buys. If it's bearish, that's a red light for buying, but a green light for selling. It just keeps you on the right side of the market's momentum. And finally, we've got the RSI. Now listen, the key word here is optional. Think of the RSI as a helpful filter. It can help confirm the strength of a trend, and that can lead to some really high probability setups. But here's the thing. Sometimes the perfect setup happens before the RSI confirms it. If you wait, you might miss the trade. That's why it's a nice to have, not a must have. Just a quick but really important note on charts. This strategy is a big fan of using range bars instead of the usual time-based charts. Like a 5-minute chart. So why is that? It's because range bars only care about price movement. A new bar only gets drawn after the price has moved a certain amount. It filters out all that useless noise when the market is just sitting there doing nothing.
All right, this is where it all comes together. We've got our tools, now we need the instruction manual. These are the non-negotiable black and white rules for pulling the trigger on a trade.
Just look at how clean this is. The rules for buying are a perfect mirror image of the rules for selling. For a long trade, you need the MACD to be bullish, the upper Bollinger Band pointing up, and the price closing right at or near that band. For a short, it's the exact reverse. Every single mandatory condition has to be met. No ifs, ands, or buts. This is what takes the guesswork out of it. So getting into a trade is only half the battle, right? Now let's talk about getting out, which is arguably even more important. This strategy uses a purely mechanical exit to take your 2 worst enemies, fear and greed, right out of the picture.
I absolutely love this analogy from the source material. Once your trade is live, you immediately place your exit orders. And then you walk away. You don't sit there and babysit it. You don't second guess it. You just set it and forget it. This is so crucial because it stops you from micromanaging and messing up a perfectly good plan.
So how do we actually set it? Well, it all comes down to one little metric, the average daily range, or ADR. All this is the average of how much the market has moved each day for the last week. This one number is the key to everything because it makes the strategy automatically adjust to the market. When things are volatile, your targets get wider. When the market's quiet, they get tighter.
Here's the first part of the calculation. Your stop loss, that's the point where you say, okay, this one didn't work, is placed at a distance of exactly 10% of that average daily range number. It's really that simple. You take the ADR, multiply it by 0.1, and that's your risk.
And here's the second part. Your profit target is placed at 15% of the average daily range. And just like that, you've locked in that all-important 1 to 1.5 risk-reward ratio that we started with. You are always shooting for a profit that's 1.5 times bigger than your potential loss.
Okay, so we've covered the math, we've covered the tools, and we've covered the rules. But you know what? None of it works without the right mindset. This last section here is the glue that holds the whole strategy together.
This is such a great mental image. Think about it. You're not trying to drive the train. You're definitely not trying to predict where the train is going to end up. Your only job is to wait patiently on the platform for that train, the trend, to come to you. You just jump on, ride it for a little bit, and then you jump off. You're an opportunist, not a fortune teller.
So when you boil it all down, it comes down to just two things. Having the patience of a saint to wait for your perfect setup to appear, and then having the ice-cold discipline to follow your plan without letting your emotions get in the way.
And that kind of leaves us with this final thought. In a world that's just jam-packed with complex algorithms and endless data, this whole strategy suggests that maybe the real edge doesn't come from more complexity, but from less. It really makes you wonder, right? Could the secret just be finding a small edge and then having the discipline to apply it over and over and over again?